7 mistakes people make when investing in crypto and how to avoid them. With Bitcoin and Ethereum reaching new all-time highs, Elon Musk and Tesla tweeting about Bitcoin and Dogecoin, and innumerable instances of people making, and sometimes losing, absurd sums of money owing to cryptocurrency, it's no surprise that more and more people are interested in investing. Although prices have recently fallen and the markets become more volatile, cryptocurrency remains a hot issue. Having said that, the world of cryptocurrency can be difficult to navigate, especially for newbies. Crypto is everything you don't understand about banking, paired with everything you don't understand about computers, someone put it succinctly. Over the previous few years, I found that many people made the same mistakes when they first started investing. Sure, I made some of them myself, which spurred the concept of this piece. Hey folks, welcome back to Billionaire Crypto Investor. In today's video, we are going to discuss the 7 most typical mistakes that people make when they first begin investing in cryptocurrency. So without any further ado, let's begin. Mistake number 1, buying high and selling low. This is the most common mistake and the one that'll most likely get you wrecked. Cryptocurrency is incredibly volatile, and significant gains come with a high risk. Sure, timing the market exactly when buying and selling are nearly impossible, but there are some clear patterns you may follow to maximize your gains and minimize your losses. People frequently make 2 major errors: FOMO, or fear of missing out, or just simply buying high. Let's face it, we've all been there. You observe a project's price increasing and want a piece of the action. Even more so if you've previously passed up similar possibilities. You don't want to miss out on anything else, so you jump in. The problem is that what goes up must come down. When you invest when a project is hot, you have a far higher probability of losing money, since early investors will start taking their profits, and you may have to wait a long time to break even, much less make any money. Furthermore, when a project's pumping hard, it may be difficult to buy in, especially if you're dealing with a decentralized exchange like Uniswap. You could lose a lot of money in gas fees on the Ethereum network, money owing to greater slippage, or transactions that become stuck and fail. FUD, fear, uncertainty, and doubt is another way of saying selling low. Few things are more disappointing than watching your investment sink further and further into the red. When a coin's fast losing value, it might be very tempting to simply sell it to get rid of it. The problem is that if the project is solid and none of the fundamentals have altered, it has a good chance of rebounding. Yes, it can be nerve-wracking, but the last thing you want to do is sell at a loss, only to watch the coin skyrocket a few days or weeks later. I'm not making this up. By the time I'm making this video, my portfolio is still profitable overall, but half of my coins are losing money, some by as much as 75 to 80%. It's terrible, but I'm just going to wait patiently. Remember that you only lose money if you sell, else it's just a number on the screen. Mistake number 2, following one-sided opinions. How did you become interested in cryptocurrency? What are your information sources? Facebook, Twitter, YouTube, Reddit? It's always a good idea to diversify your news channels to obtain a clearer picture of the market condition, regardless of who it is or how reputable that source appears to be. I personally follow all the major projects in which I am interested in Twitter, Telegram, and Discord. There are also a few paid Patreon subscriptions. Finally, a couple of newsletters, websites like Coin Bureau or CoinMarketCal, and so on. I listen, but I do not accept things at face value. I also attempt to learn as much as I can and form my own opinions, and it's difficult to do so if you only have one source of knowledge. Not at all, because what may be a solid investment for one person may not be suited for another one, owing to differences in risk tolerance, entry point, or financial goals or expectations. This leads to the following typical blunder. Mistake number 3, not having a plan. What kind of money do you want to make, and how much risk are you willing to take? When do you want to make a profit or cash out fully, either to re-enter at a reduced price or simply cash out? Are you investing for the short or long term? All of the points raised above are critical, and your responses should be consistent with your investment strategy. For example, if you plan to hold Bitcoin long term, it doesn't matter how much you paid for it, because its value will nearly certainly rise over time, if anything can be guaranteed with crypto. Sure, there are better and worse times to invest, but when it comes to long-term investments, the only way is up. A low market cap cryptocurrency, on the other hand, may theoretically provide significantly greater gains, but if you invest while the price is too high, you may have to wait a long time to recover, if it ever recovers. Mistake number 4, lack of proper security. Although it is not the most fascinating topic, it really is vital. Remember that cryptocurrency is unregulated, and the prospects of reclaiming your coins are little to none. On all social media sites, there are several phony profiles of crypto influencers. Be wary of scammers on YouTube, Twitter, Telegram, and other social media platforms. There are a number of fraudulent admin and tech support accounts, especially on Telegram. Typically, they offer ridiculously amazing freebies or conduct offers that claim to quadruple your cryptocurrency in minutes, etc. If they want you to pay them your cryptocurrency, flee. It may appear apparent, yet people have lost a lot of money this way. Being your own bank has drawbacks. Always keep your private key, password, and seed phrase safe. Never save them to a computer, phone, email, or keep them on the cloud. Instead, write them down and save them somewhere safe. Ideally, also have a copy in another secure location. Consider utilizing the Brave browser if you use MetaMask or a comparable software wallet. It has improved security and, as an added benefit, some intriguing features such as earning small amounts of cryptocurrency while surfing the web. Mistake number 5, not knowing the basics of market analysis. Have you ever wondered if Bitcoin is currently over $30,000 US and Ethereum is around $3,000 US, what if ADA or XRP would move up to similar prices? If I invest today, I can easily double my money in a few years. Well, no. In this case, the price is largely unimportant. What matters is market capitalization, which is just an asset's price multiplied by its supply. Cardano, or ADA, is now trading at roughly $1.5 US and has a market valuation of $50 billion US at this pricing. I am rounding up these numbers somewhat. So for the ADA to reach $100 per coin, its price would have to increase more than 60 times. This would give it a market cap of $3 trillion US, which would be 60 times 50 billion. To put this in context, at the same time, the total crypto market is roughly $1.6 trillion US, with Bitcoin accounting for 700 billion of that. So for ADA to reach $100 per coin, it would have to be valued at about twice as much as the entire crypto market, or more than 4 times as much as Bitcoin. Mistake number 6, either not having a diverse enough portfolio or investing in too many different coins. This is a little challenging because the content of your portfolio should be determined by your goals. If you want somewhat safe coins to store for a long time, you can very much stick to Bitcoin, Ethereum, and/or Cardano, at least in my opinion and in the current market. If, on the other hand, you're investing in considerably riskier low-cap cryptocurrencies and expecting significantly higher profits, it's prudent to avoid overexposure and decrease your risk by spreading your money among a few projects. Mistake number 7, investing money you cannot afford to lose. This should go without saying, but I'll mention it anyway. You should never invest more than you can afford to lose. Of course, no one wants to lose money, but keep in mind that cryptocurrency is incredibly volatile, and that incredible gains come with the danger of massive losses. The lesser the market capitalization, the greater the volatility and risk. Even safe bets like Bitcoin or Ethereum can quickly lose 60 to 70% when the market swings. BTC peaked at about $20,000 US in late 2017, only to fall to $3,200 a year later. When the market turns, altcoins can drop by more than 90%, and some may never recover. At the absolute least, you must be willing to retain your coins for 3 to 5 years and weather the storm. In the worst case situation, you must be prepared to lose everything, or at least a large bulk of it, if something goes tragically wrong. How much you invest and where you receive the money will be determined by your own circumstances and risk tolerance, but make sure you are completely informed of the hazards involved and consider the worst case scenario. So, I think we're at the end of the video. I hope you enjoyed it, and if you did, please give this video a thumbs up, smash the subscribe button, and press that bell icon so you never miss any updates. And if you have any questions on your mind, let me know in the comment box, and also check out our channel where you'll find more really cool stuff.